Hey guys, how's it going? My name is Spartak and I invest in real estate. I buy stocks, I bought cars, I own a junk removal company, and I do some side hustles. So today I'm going to show you guys how to invest passively. This includes stocks, bonds, ETFs, real estate, and I'll be talking about it real quick. I'm not a financial wizard. This is personal finance. This is just showing you guys some money basics. So let's get this started. All right, so first you want to know what you're investing in. So what to invest in. Let's grow this. What to invest, right? Some people are like, what do you mean? Like, I can invest in stocks, I can invest in this and that, I can do this. You need to know exactly what you want to invest. So you have to be a little bit smart about it. So your examples: stocks, real estate, bonds. Those are probably your main three, and stocks and bonds are very similar. So this is how we're going to invest passively. So investing passively means you're not going to put up the work up front. Like if you want to flip a real estate property, you need time and effort and physical labor maybe. But if you're doing it passively, it really means that you just kind of throw money at it and it makes you money. So let's show you how to do that. So say you want to get into stocks, right? You're like, oh, I'm going to invest passively in stocks. So you have $1,000, right? To invest this passively in a stock, you would get this $1,000 and purchase a stock. So a stock, which is a part of a company or a share of a company, very little piece of a company, right? You have $1,000, you buy a stock. This stock will trade like this. Most of the time, it depends. If you get a S&P 500, most of the time the trend will look like this. Here's the trend. It's gonna go like this, but it'll average upward most of the time. On average, we're looking around 7 to 12% on average. This really depends on the year, government spending, all kinds of stuff. So stocks, this is how it makes you money. Say this $1,000 in stocks yields you 10%, right? It'll come back at you. Say in a year, around a year, it's about 10%. So it'll come back at you and it'll be $1,100. So you put up that money up front to buy a piece of stock that went up 10%, and boom, you got $1,100 now. Doesn't seem like a lot, but when you have a lot of money in it, it builds up. So, whoops. So, let's see. Let's grow this up a little bit. There's all kinds of stocks. So, when you're investing in a stock, you need to know what particular stock. Are you doing an ETF? Are you doing a mutual fund? Are you doing a 401k? Investing stocks in that 401k. What kind of stock? Are you going for growth stock? Are you going for dividend yield? Are you going low dividend yield, high growth? What are you doing? So, stocks. You want to know what kind? Are you going ETF? ETF. So this is pretty much a piece of a company. It's pretty much an index fund that's traded as a stock. Let me explain that. Or a mutual fund. Say a bunch of investors. Well, it's not really a bunch of investors. It's like this. This is an index fund. Here's a pile. These are all different companies. All different companies, right? You're buying a portion of all these different companies. Similar to the S&P 500, which is pretty much this, but 500 of these, like a bunch, 500 of the top companies in the United States. That's what the S&P 500 is. So these are pretty much, you're buying a small piece of all these companies. Most likely, some of those companies might go up, some might go bankrupt, but overall, most of the time, they tend to go up if you pick the right ETF. So you can buy those in shares. You don't need a minimum amount. Those might be like, oh, $50 a share. So you're like, oh, okay, I can buy 20 of them. Okay, you do that. Then you have a few other things. You have index funds. You have mutual funds. You have index funds. These are going to be pretty much the same thing as an ETF, but sometimes they require a minimum balance. They'll require maybe $3,000, $3,500, $5,000 initial investment. Then, so here's that pie again, right? Different pie. They'll have a portfolio manager sometimes recording all this. And they'll be like, hey, we're paying sometimes it's the manager, sometimes it's computer, it's a little bit. And these tend to be 0.02% to, it's a very small percentage that they tack off. It's between 0.02 and almost like 2% that you're paying in fees to have that managed. Now, mutual funds are a little bit more expensive. It's the exact same thing as an index fund, but you're paying more in fees. Why do that? Some mutual funds perform a lot better than index funds, but most of the times index funds are pretty good too. Next, if you do a stock, is it growth? Or are you going divs? Or both? Like, I don't know. You can invest, sometimes mutual funds will have just dividends, or they'll have just growth stocks, or sometimes they'll have a mixture of both, like the S&P 500. But you really need to know. A growth stock is going to have their charts most of the time. Okay, let me explain what a growth stock is. So say a growth stock such as Tesla, right? Their ticker symbol, I'm pretty sure, is TSLA, right? This is what's going to happen. Say Tesla, right? Makes money from selling cars, right? Tesla makes money, they sell cars, right? The consumer pays Tesla, right? What does Tesla do with that money? They reinvest it. They literally reinvest the money back into Tesla. The thing with a dividend stock, such as like Coke or something else, or Coke, AT&T, Home Depot, they're gonna do this. So Coke, ticker symbol is KO, is it KOKE? Or it just might be K. I'm really not sure. So say Coke. They make money off a consumer. This is you that owns stock. You're gonna make money off the consumer. Invest some of it back into Coke, but they're such a big business that they might give back 1% to all shareholders. If they make $100 billion, they're gonna give you 1%. So maybe $1 billion goes back to all shareholders in dividends. And dividends are paid out per quarter. So like every 3 months, they'll pay you out. Some places do it per month, but most places do it every 3 months. So let me break down the other ones. That's pretty much in stocks. So what happens with stocks, when you identify what you want, when you identify exactly what you want, you can go ahead, throw money into it. This $1,000 is gonna buy you some stock, right? And you can do two things with it. If it gives you a dividend yield, pays you back a dividend yield, right? This is your dividend cash. It could be like 1% a month. It could be 7% a year. It could be 5% a year, whatever it is. You could either get money from it, or what I do is just buy more stock with that dividend, and it just compounds into a snowball. You have 5% more stock. Oh, 10% more stock, free more stock. When you cash out that stock, sometimes you pay tax, sometimes you don't. Depends how much money you make. I would recommend reinvesting your dividends just because you're not paying really anything until you pull it out. And sometimes you don't even pay taxes because you're not making that much money. Reinvest that dividend. If it doesn't pay a dividend, okay, it doesn't pay a dividend. ETFs, the same thing. Same thing. ETFs, index funds, mutual funds, they're the same. So, stocks, we covered that. Real estate, we're going to talk about that in REITs. This is probably the most passive way to do it. So this is pretty much a trust. It's a real estate investment trust. So this is pretty much what happens. Say you have $1,000. and you're like, yo, I want to get into real estate, you know? So this is what a REIT is, and I'll explain it. So REIT, let me just explain what a REIT is at first. Say you're Joe Schmo right here, and you have some money, right? You're like, oh, I want to invest in real estate, okay? You can't just buy a house. You can't do that. You don't have enough money. You only have $1,000. It's very hard to buy a house with $1,000. It's possible, but very hard. So what you do is you take your $1,000, you go ahead and spend it on 500 units. 500 unit apartment complex, huge apartment complex, bunch of apartments and stuff, a ton, 500, 1,500, whatever. You take your $1,000, you give it to these guys, and then other people did the same. A lot of other people did the same, right? They're all buying into this deal. This is a trust. It might be $1,000, but if you have 500 or 1,000 people putting in $1,000, that's $500,000 or $1 million into this deal. That could be a down payment to buy that, right? And then they buy this. All these apartments collect rent, right? Rent money. That rent money, where does it go? It goes into expenses, right? We have maintenance on the property. We have employees and random stuff, etc. A very small percentage of it goes back into here, goes back to you, or as you would like to call it, the trust. In dividends, they're going to pay either every month or every quarter. It does depend on what kind of REIT you're doing. You could do 1% every 3 months. You could have 3% every 3 months, 2%. It just really depends on the rate. So, same exact thing as stocks. Either reinvest back into there to buy more, or cash out. Whatever one you like to do. With that $1,000, this is how it's going to grow. You put in $1,000, right? And say average is about, say 7% a year. You're making about $70 a year. Not bad. I wouldn't be mad about that. But I would not be bawling out about that at all. So, how do you grow that? Say that $70, you add another $1,000 a year. $2,070. So you pretty much made $70. And then this grows at 70%. Let me whip out my calculator. We're at 2,070, right? Correct? Times 0.07. This is another, now your dividend is $145. Your dividend more than doubled. So it just keeps doing that, you know? It'll keep doing that until you have a lot of money and a lot of money comes back to you. That's one of the great things about dividend investing, is because it just keeps snowballing. So that's how you make money off of that. I'm glad you guys understood that. So real estate investment, bonds. Let's understand bonds. Bonds are good to know. A lot of people will say you need some bonds and stocks in your portfolio. Times have changed. Okay, so bonds. Bonds are pretty much the gov. Gov being like, yo, I owe you money. Let me explain. So, you want to buy a bond. Bonds tend to have a bond yield, right? So this is what it is. You're Joe Schmo again, right? And you have money. Say you have $1,000. And they're like, hey, there's a 10-year bond with 20% yield, right? That's pretty high. That's pretty high. So 10 years with 20% yield, right? Let's think. This money, you cannot touch it for 10 years. 10 years. 10 years you can't touch this money at 20%, right? So in 10 years, your $1,000 will give back, they'll pay you $200 after 10 years. for borrowing your $1,000. What happens with bonds is, this is what happens. Most of the time after war or before war, the government will ask for bonds and increase bond yields so people buy more bonds. What happens with your money is the government will use that money right now. They'll use it right now and be like, hey, we'll pay you later back. Because they'll build roads, they'll build hospitals, stuff like that. They use the money for maybe the military or whatever. They're using the money and they'll give you back money. But the bond yields are a lot lower than stocks most of the time. If you buy S&P 500, it's completely different. Now explain that real quick. Let me show you guys. So say you're doing stocks versus bonds. Hope you guys can see that. Yeah, stocks versus bonds. Let's go. So say we're gonna break it up to year, 1 year, 2 year, 3 year, 4 year. Right? We'll do stocks, bonds. Right? Split that right there. First year, say 7%, 10%, 2%. Negative 2%. Bonds are like this: 3%, 4%, 5%, 3%. Bonds are consistent, but they're consistently low most of the time. This 7 plus 10 is 17, 18, 19, minus 2 is 17 divided by 4. So this is going to give you your average: 17 divided by 4. 4.25. Most of the time, it's an average of 7%. But say this is only 4 years, and you've had a bad year, right? This one's going to be 3 plus 4 plus 5 plus 3. 15 divided by 4. This is 3.75%. Stocks win just by a little bit, but this could be a hectic year. This is a very hectic year. 7%, 10%. These are low returns, and they still win with a negative 2%. The thing is, when inflation gets you, it eats your money like rats. If you're like last year, apparently there was a 7% inflation rate, right? So if you have bonds yielding you only 3% and inflation 7%, you're going negative 4%. Most likely because the value of your money, according to the consumer price index, is going down. So you really want to keep that in mind. You want to be yielding between 7 and 10%. S&P 500 should be your bet. So we got that taken care of. Number 2, invest. Once you know what you're investing into, you need to start investing fast. So this is how we're going to do it. Say you work, right? You work your job. This is you with your job. You work. You might be working blue collar. This is green collar. So you work your job, you get paid, right? Before you get your money, take this. Have your account. Put 10%, I would say 5 through 15% of your money. 5 through 15% of your gross income, I would put it into some kind of passive investment that you know would make between 7 and 10%. S&P 500 is a great example. You can do this with multiple brokerages. Before you get, here's your paycheck. This money goes out to you. This money goes automatically to your investments. You don't even see it. Same day you get paid, same day it gets taken out. I want it like that. Because if you don't have access to it, and you're like, oh, I have $1,000 in my account, right? But at the end of the month, I need to put away 200. Yeah, that's gonna get messed up, I promise you. Just go ahead and have it the same day taken in now. because unconsciously you're gonna be like, oh, I only have 500. You know, like you see only 500, but you don't realize how much money is working for you. Like, don't just work for your money. So as soon as it hits, take it out. And I'll name a few websites that can do this for you. And that 5 through 15% depends on how well you are financially already. If you're not doing too well financially yet, pay off your debt first, then invest. If you can get a better percentage on this compared to your debt, if your debt's 1%, 2%, go ahead and invest. But make sure you can pay everything. Do not over invest. I had that problem managing my cash flow. I'd be making $5,000 a month when I was about 17 rebuilding dirt bikes. And it was crazy. I would rebuild dirt bikes, make a lot of money, and I was working at Menchie's. So I would make crazy amounts of money and be like, where is all my money? I was putting 25% of my income into stocks, and the rest was going back into my business. So I literally just had no money because my cash flow was mismanaged. So manage your cash flow well. So this would be cash flow. Know how to manage it. So this is what we're gonna do for examples. For places to invest into, I'm gonna use a different marker because this marker is bad. I would definitely do Vanguard. That's awful. Come on. Vanguard. Vanguard was a great, I use Vanguard for a high dividend yield portfolio. It's awesome. It takes it right away, either every month or every time I get paid. I can set it a certain date. You can do every single day. You can do bi-weekly, weekly, monthly, every 2 months. Vanguard. TD Ameritrade's good. Robinhood, I say Robinhood's okay, but it's on your phone, so you have too easy of an access. If your access is easy, it means you're gonna pull it out fast. So I would recommend just these two. If you guys need help setting it up, please comment down below. I'll make another video setting up automatic investments and describing how to do so. If you like this, like the video, guys, give it a thumbs up, subscribe. This is like the content that I like doing. I'm trying to do it with no cuts and just being raw footage so you guys can get authentic me. So thank you for watching, guys. Have a great one.